In 1171, the Byzantine Empire made an unexpected move. It arrested all Venetian merchants in Constantinople. It confiscated their goods. It seized their ships. Thousands of Venetians were taken prisoner. Why? Byzantium feared Venice's growing power. This small city-state that controlled Mediterranean trade had now become a threat. The Venetian Doge, Vitale II Michiel, immediately declared war. But he had a problem. War required money. Navy, soldiers, weapons. The treasury was empty. Normal tax revenues were insufficient. Borrowing was necessary, but how? The Venetian government made a revolutionary decision. It would take forced loans from wealthy citizens. This wasn't a tax, it was a loan. The government would pay interest, and the debt could be sold. In other words, a type of security. This decision would change the course of financial history. This is how Monte Vecchio was born. In medieval Europe, kingdoms and city-states constantly suffered from money shortages. Wars were expensive, castles were expensive, palaces were expensive, but the tax collection system was primitive. Feudal lords collected taxes from their own lands, but were reluctant to give to the king. The church didn't pay taxes. Peasants were poor, so paid very little tax. How did rulers find money? There were several methods. First, selling or pawning valuables, crowns, jewels, lands. Second, currency debasement, mixing less valuable metal into gold and silver coins. Third, borrowing from bankers. But this was risky. Interest rates would be very high, and if unpaid, bankers would go bankrupt. Venice found a different way, borrowing from the public, but doing so systematically and sustainably. The Monte Vecchio system was the product of this vision. In 1171, the Venetian government demanded a mandatory prestito, loan, from all wealthy citizens. An amount was determined according to each citizen's wealth. The richest merchants paid thousands of lire. Middle-class merchants paid hundreds of lire. Approximately 150,000 lire was collected in total. This was an enormous amount for the time. But this wasn't just forcibly taken money. Venice pledged to pay 5% interest, and most importantly, these debt certificates could be bought and sold. If a merchant needed money, he could sell his debt certificate to someone else. A secondary market formed, the first example of a modern bond market. The system was complex but functional. The Venetian government established the Ufficio del Debito Pubblico, public debt office. This office kept debt records. It managed interest payments. It recorded transactions. Each citizen had an account in the Great Ledger. Debts were written in this ledger. Transactions were updated in the ledger. The name Monte Vecchio meant Old Mountain. Why? Because the debt ledger became very thick. It rose like a mountain. Over time, each new debt campaign was called a Monte, Monte Nuovo, Monte Novissimo, but the original 1171 debt always remained Monte Vecchio. The advantages Venice gained from this system were enormous. First, rapid capital access. In times of war or crisis, the government could quickly raise money. Second, lower interest. Bankers would demand 15 to 20% interest. Venice paid 5%. Third, social stability. Wealthy citizens supported the state because they had stakes in the state's success. The system was initially mandatory. The wealthy complained. They said this is like a tax, but over time they saw the advantages. Interest income was secure. Debt certificates were liquid, easily sold. Some even saw it as a speculative investment. Prices would fall when war news came, rise in peacetime. In 1202, Venice again faced money shortages for the Fourth Crusade. This time, even larger amounts were needed. Doge Enrico Dandolo was old and blind, but known for his sharp intelligence. He saw a tremendous opportunity for Venice. The Crusaders sacked Constantinople. Venice took the lion's share of the loot: gold, silver, holy relics, and most importantly, trading privileges. This wealth flowed back to Monte Vecchio. Debts were paid, new debts were taken, the system expanded. Now not just forced loans, but voluntary bond sales began. Citizens wanted to invest in Venetian bonds. They were considered safe. By the 14th century, Venice's debt system had become extremely sophisticated. There were different types of bonds: short-term, long-term, perpetual. Some paid higher interest but were riskier. Some paid lower interest but were very safe. Investors chose according to their risk tolerance.
In the square near the Rialto Bridge, bond trading took place. Brokers shouted prices, merchants negotiated, ledger records were updated. This was the precursor to the modern stock exchange, but not stocks. Government bonds were traded. Venice's wealth was largely based on this financial system. Trade was important, of course, spices, silk, glass, but financial innovations set Venice apart from its rivals. Genoa, Pisa, Florence, all were strong trading cities, but none developed as sophisticated a debt system as Venice. Monte Vecchio's success was also tied to Venice's political stability. Venice was an oligarchy. Approximately 200 wealthy families ran the city. The Maggior Concilio, Great Council, consisted of representatives from these families. The Doge was elected, but his power was limited. Real power was in the council. This system provided stability. No coups, no civil wars, smooth power transitions, and most importantly, property rights were protected. Citizens trusted that the government wouldn't forcibly seize their bonds.
This trust is the foundation of financial systems. But the system wasn't perfect. There were problems. First, forced loans. Citizens couldn't object. The wealthy were forced to invest large portions of their assets in bonds. This would lead to liquidity problems. Some were forced to sell assets to meet debt payments. Second, the repayment problem. Venice never fully repaid its debt. It paid interest, yes, but principal wasn't repaid. Monte Vecchio became a perpetual debt. It continued for generations. Grandchildren would receive interest from debt certificates their grandfathers had received. Third, interest rate changes. In wartime, Venice would be forced to borrow more. Interest rates would change. This affected the value of old bonds. Sometimes bond prices would fall to half their nominal value. Investors would suffer losses. Fourth, corruption risk. Officials managing the debt ledgers could manipulate. They could change records, erase records. Venice imposed strict controls to minimize this risk, but the risk never completely disappeared. In 1379 to 1381, the War of Chioggia nearly destroyed Venice. Genoa besieged Venice. The city faced starvation. The treasury emptied. Monte Vecchio was the last resort. The government made emergency borrowing. Interest rates were raised to 10%. Citizens contributed out of patriotism and self-interest. Venice won, but the fiscal situation was terrible. Debt had reached enormous levels. Interest payments consumed half the annual budget. The government had to find a solution. The solution? More borrowing. New loans to pay old debts. It looked like a Ponzi scheme, but it worked because the Venetian economy continued growing. Trade developed. Tax revenues increased. The system remained sustainable. In the 15th century, Venice's debt system inspired other parts of Europe. Florence established a similar system. It called it Monte Commune. Genoa established the Cassa di San Giorgio. This was a type of state bank that managed debt. The Netherlands adopted the Venetian model in the 16th century. Spain tried but never succeeded. England established the Bank of England in 1693. Its initial purpose was to finance the king's war debts. It was inspired by the Venetian model, but the English system was even more advanced. Central bank, monetary policy, full state backing, it was the direct precursor to the modern government debt system. The fundamental factor behind Monte Vecchio's success was trust. Venetian citizens trusted that the government would pay interest. This trust came from political stability, from the rule of law, from the protection of property rights, and most importantly, from the oligarchic system being aligned with its own interests. Wealthy families were both in government and among bondholders. They were essentially borrowing from themselves. When modern economists study Monte Vecchio, they draw several critical lessons. First, government borrowing can be sustainable. If the economy is growing, if tax revenues are increasing, debt isn't a problem. Second, financial markets provide liquidity. The ability to buy and sell bonds increases investor confidence. Third, institutional quality is critical. Trustworthy government means trustworthy debt. But at the same time, there are risks. Excessive borrowing can lead to disaster. If debt grows faster than the economy, the system becomes unsustainable. Interest payments consume the budget. There's no room for new spending. Eventually, default becomes inevitable. Venice managed to escape this trap because its economy was strong.
Trade developed. Industry grew. Glass, textiles, shipbuilding. Tax revenues constantly increased. Debt remained manageable.
But in the 16th century, the situation changed. The rise of the Ottoman Empire hit Venice's eastern trade. In 1453, Constantinople fell. This was a strategic blow to Venice. Trade routes were endangered, costs increased, revenue fell. Portugal and Spain's discoveries in the Atlantic Ocean changed the spice trade. The Indian Ocean could now be reached via the Cape of Good Hope. Venice's Mediterranean routes became secondary. Trade volume fell. This economic decline affected Monte Vecchio. Tax revenues fell, interest payments became more difficult. Sometimes Venice postponed interest payments. Sometimes it unilaterally reduced interest rates. Bondholders suffered losses. But the system didn't completely collapse, it just weakened. In the 17th century, Venice was no longer a front-rank European power. The Netherlands, England, France, these were the new powers. Venice became a small regional player, but Monte Vecchio still operated. Interest was still paid, bonds were still bought and sold. The system lived for 600 years. In 1797, Napoleon conquered Venice. The independent Venetian Republic ended. Monte Vecchio also ended. The Austrian Empire took over Venice. Debts were transferred to the new government, but the old system disappeared. Today, in Venice's old Palazzo Ducale, Doge's Palace, Monte Vecchio records are displayed. Old ledgers, yellowed pages, handwritten notes. Tourists take photos, but most don't know what these ledgers mean. These were the birth certificates of modern finance. Monte Vecchio's legacy can be seen everywhere today. Every country issues government bonds. U.S. Treasury bonds, German Bunds, Japanese JGBs, all are continuations of the tradition Venice started in 1171. Governments borrow from the public. They pay interest. Bonds are bought and sold. Modern bond markets are much more sophisticated. Electronic trading, credit rating agencies, derivative products, but the basic principle is the same. Government borrows today against future revenues. Investors provide capital in exchange for interest. What was the secret of Monte Vecchio's success? 3 factors. First, political stability. The Venetian oligarchy lasted over 1,000 years. Internal conflicts were minimal. Second, rule of law. Property rights were protected. Contracts were enforced. Third, economic growth. Venice became wealthy. This made debt service sustainable. Modern economies try to apply the same principles. Political stability increases investor confidence. Rule of law protects property rights. Economic growth ensures debt sustainability. Without these 3 factors, government borrowing becomes dangerous. But there are also risks. Excessive borrowing can lead to disaster. Greece experienced a crisis in 2010. Debt reached 180% of GDP. It became unsustainable. Default became inevitable. Venezuela, Argentina, Lebanon all experienced similar crises. Japan is a different example. Debt exceeds 250% of GDP, but no crisis. Why? Because most of the debt is owned by domestic investors. The Japanese people invest in Japanese government bonds. There's trust. Also, Japan is economically stable. Inflation is low. This makes high debt manageable. Monte Vecchio teaches us this. Government debt isn't bad. If properly managed, it can finance economic growth. Infrastructure, education, defense, these are long-term investments. Financing through borrowing makes sense, but discipline is essential. Debt must be kept at sustainable levels. Interest payments mustn't consume the budget. Venice's experience also shows the power of financial innovation. Monte Vecchio was the most sophisticated financial instrument of its time. Venice gained a huge advantage over its rivals. It could borrow more cheaply. It raised capital faster. It could finance wars. It expanded trade. Modern economies operate with the same logic. Financial innovations support economic growth. Stocks, bonds, derivatives, crypto, all enable more efficient capital distribution. But every innovation also brings risk. The 2008 financial crisis resulted from misuse of derivative products. Innovation must be balanced with regulation. Another lesson from Monte Vecchio is the importance of transparency in record-keeping. Venice's great ledger system recorded all transactions, who borrowed how much,
who received interest, who sold bonds. This transparency created trust. Investors could trust the system. Modern financial systems are based on the same principle. Blockchain technology, for example, keeps distributed records. Every transaction is transparent and immutable. This increases trust. It reduces manipulation risk. In conclusion, Venice's Monte Vecchio system is one of the turning points in financial history. The invention of the government bond laid the foundation of the modern economy. Governments could finance major projects by borrowing from the public. Investors found a safe and liquid investment vehicle. Venice was a small city-state, but through financial innovations, it became the superpower of its age. For 300 years, Monte Vecchio was the foundation of Venice's power. The system survived through the trinity of political stability, rule of law, and economic growth. Today, boats passing under the Rialto Bridge pass by the square where old bond traders shouted. Tourists admire Venice's beauty, canals, palaces, churches, but Venice's true legacy is invisible. In financial systems, in bond markets, in central banks, the spirit of Monte Vecchio still lives.